Good morning, good afternoon. Is everyone in the morning where you are? I assume you are. Um, we are going to do a topic today, business combinations, which actually appears a good amount of times on the exam. And they've been giving really task-based simulations on it. Now, we're going to go through, first of all,
Can you hear me?
I'm sorry?
Sorry, I was testing to make sure you could hear me.
That's all right. Who did that? Slap that person
This is
around. Get him out.
this is Teresa.
Okay.
Sorry. Hello.
Teresa. Oh, good morning. How are you?
Hi. Fine, thanks.
So anyway, we're going to talk about consolidations. Now, this is going to be different. If you took consolidations in school, they don't teach it like this because they teach it the way I'm going to show you from the standpoint of the exam. The exam expects you to know the way we do it. All right. And also, most people today don't take it because they don't take advanced accounting. All right. Now, let us move on. The first thing I'm going to do is, all right, I want you to open up your book to page 3B as in boy 1, right? And we haven't heard back, obviously. All right, but here we go. All right, now I want to show you the first blueprint. All right, if you have don't worry about it. If you have the book, great. All right, if you don't, just jot some of these terms down. Now, the first, it says recall basic consolidation concepts and terms, such as controlling interest, non-controlling interest, primary beneficiary, and variable interest entity. All right, now it says here, the method we use to consolidate a parent and a sub. All right, so what you're going to have here is this. All right, it's only a parent and a sub. As I get rid of this marker, first marker of the day, bye. All right, the parent must acquire more than 50% of the outstanding voting stock, not non-voting. It's got to be the voting stock. So if a company acquires more than 50% of the preferred stock, all right, that is not a parent-subsidiary relationship. All right, now what will happen is the parent will acquire the sub, and both parents and the subs will continue to maintain their own books. All right, they're going to have own books. All right, which means that any elimination entries and adjustments that we're going to make are going to be made just on a worksheet, because the bringing together of the parent and the sub, all right, is done on a worksheet. And there are certain adjustments and eliminations that we will go over, and basically that's all they can ask you. All right, now remember this. The theory is this: when you consolidate, all right, the surviving company is the parent. So it says this, they can ask you this: whose retained earnings is the consolidated retained earnings? I'm sorry? All right. Whose retained earnings is the consolidated retained earnings? If the surviving company, and we're eliminating the subsidiary, we're going to eliminate that. All right. So therefore, all of the stockholders' equity, the consolidated stockholders' equity is the parents. So if they say to you, all right, what is the consolidated retained earnings? It's the retained earnings of the parent. All right. What is the consolidated dividends paid? It's whatever the parent paid during the period. It's just the parent, because remember, dividends paid is a reduction of retained earnings. All right. So remember, surviving company is the parent. And we're going to make all these intercompany eliminations and adjustments, because remember, the parent and the sub are really the same company. All right. But you cannot make a profit selling to the sub because it's yourself. And if the subsidiary sells anything to the parent, if there's any profit or loss on the transaction, it must be eliminated. All right. Because you cannot show making a profit to yourself, which means from the parent to the sub, or the sub to the parent. So any accounts that are on the subsidiary's books or the parent's books, all right, if they involve some type of relationship between the two companies, they have to be eliminated on the worksheet. All right, you don't eliminate them on the parent's books or the sub's books. Okay. Now, if they say to you, all right, that the company is the acquirer, all right? Let's look at this, all right? The acquirer, acquirer, all right? The acquirer is the parent company, all right? That's the same thing as parent. The acquiree is the subsidiary. Now, you don't have to worry about that because they'll tell you, you see the questions, they'll tell you that, all right, Bill Company acquired 60% of Tom Company. So you know that Bill is probably the parent company, all right? Now, the method we use is called the acquisition method. And in the acquisition method, we're going to bring the companies together and eliminate intercompany eliminations and adjustments on a worksheet. That's what you'll see, all right? And you could have another type of acquisition, all right, which they generally don't ask on the exam. It's called an asset acquisition, all right? Now, this is called just an acquisition, what we're going to do today. But if a company has an asset acquisition, they are actually buying the assets of the company that they're acquiring, all right? And those assets of the company they're acquiring are going to go on the books of the company that's buying them, all right? So eventually, that company that they're buying goes out of business, all right? That's called an asset acquisition, all right? But this is not an asset acquisition. This is just the acquisition method, or as they call it, a business acquisition, where the parent is not really acquiring the assets of the sub, the liabilities, and therefore, all right, remember, if the entries are made on a worksheet, it's called a what? Business acquisition or just an acquisition. All right, now going down on the bottom, all right, we have a controlling interest. All right, if the parent owns more than 50% of the stock of another company, the parent has a what? A controlling interest, and they must consolidate. Remember that. They must consolidate. And also one other requirement. If they consolidate, the consolidation cannot be temporary. Now, when is the consolidation temporary? If the parent acquires a sub that's going through bankruptcy, all right, you're not going to combine them or consolidate them because the sub will be gone probably by the end of the year. So it has to be permanent control. Remember that. And it's only owning more than 50% of the stock, not the non-voting stock. All right. The non-controlling interest, if you had this in school, you might have called it minority interest. It's no longer called minority interest. This is a non-controlling interest. And this is when another company owns less than let me start again. Another company owns 50% or less of the subsidiary, all right? They are the non-controlling interest, all right? Now, here's a term, all right? The primary beneficiary, and also, all right, it says here, the variable interest entity. Now, you can have a situation where a company acquires less, 50% or less of another company, and they still might consolidate, all right? Now, that's because the relationship was a primary beneficiary and a variable interest entity. Now let's read the definition here. The primary beneficiary has a controlling interest, but not by owning more than 50% of the common stock. So this is the way you can control the company, all right, not own more than 50%. Now, go down to the last sentence of this paragraph. The primary beneficiary, all right, will have control of the company, I just put those words in, if they guarantee that they will absorb the losses of the variable interest entity, and if the variable interest entity cannot absorb the losses, all right, they have the right to receive the benefits from the company, all right? So let's put it this way. Let's assume that I am General Motors, all right, and there's a car company called the Rent-A-Wreck Car Company, okay? All right, now, they are suffering terrible losses, but Rent-A-Wreck has all this fancy new technology that I could use. Now, remember, if I buy Rent-A-Wreck, all right, and I don't have to buy more than 50%, I could buy 20% of their stock. But by doing that, what happens is I control the company because Rent-A-Wreck can't pay for the losses. All right. Now, if I, the primary beneficiary, guarantee the losses, the debts of that variable interest entity, all right, then what happens? We must consolidate, all right? So the variable, it's generally a situation where you have a subsidiary where they're generating a lot of losses. They can't pay their debts, all right? So therefore, the primary beneficiary says, you know what? I'm going to acquire a lot of their assets. I need them, their technology. And you know what? As a primary beneficiary, I will guarantee the losses of the company, all right? I will guarantee any future debts. So now, all right, the variable interest entity can continue to operate, all right, because companies will lend them money, all right, and if they have losses, all right, the variable interest entity, they'll still lend them money, all right? So this is a situation where you have two entities, the primary beneficiary and the variable interest entity. And we don't care about the percentage ownership of stock, all right, to consolidate. Basically, if the primary beneficiary can control the variable interest entity, it doesn't make any difference what percentage they own, all right, they must consolidate, all right? Now, the next thing, acquisition-related costs, all right? When you acquire another company, all right, you may have the following costs, all right? First of all, accounting costs. If I'm going to acquire stock in another company, all right, I'm going to check out all their, books and so forth and so on. So therefore, I'll have accounting costs as a parent company, all right? Finder's fees, all right? If I ask a finder to find me a company that I could invest in, all right, which would be basically helpful to my company, all right, then that's a finder's fee. And professional fees and consulting fees. But what do you have to know about this? Finder's fees, consulting fees, all right, accounting costs. The way you treat them is on the books of the parent, all right, or on the subsidiary. The bottom line is, well, it's not the subsidiary. Acquisition costs generally occur to the parent company. But remember, all acquisition costs are expensed. Remember that. Then we have other costs, and this is what they are. Generally, when you acquire the stock in another company, all right, you, the parent, may issue you more of your stock to acquire the stock of the subsidiary. All right, now, if you issue stock, we're dealing here with publicly held companies. And with publicly held companies, all right, what's going to happen? Well, before the parent can issue more stock to acquire the subsidiary stock, all right, they're going to incur SEC registration fees, all right? There's going to be underwriting costs, which are the costs to advertise the new stock, all right? So we have here any costs having to do with the issuance of the new stock of the parent, all right, is also an entry you make on the books. And what do? You don't debit expense, you debit paid in capital. So if I have registration fees that are paid to the SEC, all right, the parent company on their books will debit paid in capital, all right, registration fees, and credit cash. Remember, any costs having to do with the registration, the issuance of that stock by the parent, all right, is considered a reduction of paid in capital. A separate paid in capital account, you could call it paid in capital, all right, SEC fees, that type of thing, okay? All right, now, let's go to page 3B2, which is in your handout. All right, now, on the top, 3B2 on the top, all right, here's the first bullet. Both the acquisition costs and the costs of issuing a stock are recorded on the books of the acquirer or the parent.
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.